Welcome, everybody, to the Sprague Market Brief for February 22nd, 2012. I think you all know us by now. It's Hugh and Taylor. Hugh, these reports are becoming depressing, I think, for us to record every couple of days. We've had another week of up moves in the markets, and I think we're looking for any signs of good news that we could possibly get. Everybody's looking at the WTI chart right here, and you can see that we've broken out of the $100 range, and we are on a steady march for new highs. And unfortunately, those highs that will function as resistance are not found until about $115 on the WTI chart, which corresponds to our highs we hit early last May, so May 2nd of 2011. Support under the market at the moving averages. If I go to the RBOB or gasoline chart, this looks like a runaway train, although it's a fairly organized chart. There's not any dramatic moves, just steady higher highs, higher lows, classic bull market as we head higher. If I go to the weekly RBOB chart, you can see we do have some resistance on the chart that's a little lower than last May. That would be a high of 316.10 hit back in July of 2011. Beyond that, it's another 32 cents before we hit the highs back in April of 2011. So gasoline continues to march north as well. On the 2-oil chart, we want to point out that the market is moving towards those last spring highs. We're trading in the neighborhood of 327 right now. We hit a high of 331.97 last April 4th, the week of April 4th, 2011. So we are only really 4 or 5 cents away from that high point. Now, what we want to talk about today was some of the movements that we've seen and compare them to some other price spike time periods. And I'll point out before we leave this chart that 1 year ago, between January and April, we saw a similar price spike. We saw the market move quite dramatically, 80 cents actually, from the 250 level in January all the way up to 330 in April. So these winter, early spring price spikes are not anything new. We saw one last year. Unfortunately, if you were going to argue for another 80-cent move this year, we just got started really at 302, and we're only at 327 so far. So we hope that that is not going to be the case this year. I think that we really want to talk about whether we're going to collapse like we did in 2011, or unfortunately what's been on the news lately is a lot of discussion about 2008. So this is a weekly chart that highlights the spring of 2008 and everybody's painful ride to all-time highs. What's interesting to us is the fact that in March of 2008, the market was trading at roughly the same level, $3.22, and it had risen about 80 cents, a lot like last spring. It went from 240 up to 320. But obviously, later in the spring, in April, we started the surge higher, where we went another 90 cents. This is very depressing, and we do not want to see the same type of surge. So the question for us today, Hugh, and really the debate is, we're at a crossing point now. Do we collapse like we did in 2011, or do we surge higher like we did in 2008? I think we're all gunning for some 2011 price action. So do you see any similarities or differences that we should talk about here?
Yes, I think there are, Taylor. There are two specifically that come to mind. One is the major growth in speculative long positions that occurred in early 2011, going up through that early May time frame when the great collapse occurred. $10 down, you may recall, in one day, 26 cents a gallon in the heating oil. And what's happening now? In 2011, at this time, or by the end, of the run-up, Speculators had amassed 400 million barrel speculative length in crude oil, a ratio of 10 longs to every short. This year, we are already actually where we were at this time last year, 300 million barrels long, a ratio of 7 to 1. If that keeps on going, it suggests very strongly that there won't be enough to support that kind of untenable imbalance between buyers and sellers, basically between shorts and longs. The second thing that I find even more impressive this year is the fact that we've got Europe tipping into recession. This was nowhere near the case, although the debt issues were already starting to surface at this time last year. The second thing is European consumers are currently already paying what we were paying in dollar terms in 2008 due to a dramatic reversal in the strength of the euro versus the dollar. You got to believe that if they were paying $8 and $9 or $10 a gallon is what they generally pay anyway, and now they're paying, who knows, $12, $15 a gallon, they're probably going to be cutting back. The other important or significant indication now is that Asian growth, particularly Chinese economic growth, may be slowing as a result of the impact of the European recession. And if that occurs, and this was not even a twinkle in the cards, or if that's to mix analogies, this time last year, if that occurs, then we could really see a dramatic fall off in global demand growth, if not, in fact, in demand itself.
That's nice. I hear you. But I watch CNBC like everybody else every day, and all I see are talking heads talking about higher price this, higher price that. We're going to $150 crude. How, I don't understand.
Well, yeah, I agree. I agree with you. Nobody seems to be terribly worried, do they? There are warning signs out there, but this time last year, again, Taylor, it wasn't until, let me see, it was at the end of March that the J.P. Morgans, Goldman Sachs, Deutsche Banks, other influential and respected, in some cases, institutions were upping their forecasts for 2011 values significantly. I mean, up to 118 in Brent by J.P. Morgan from 108 up to 124, I think.
Wait a minute. So you're telling me that a couple of weeks prior to the massive sell-off, the smart money, quote unquote, was on CNBC actually upping their forecast for oil pricing?
The smart money, the heavy hitters with the zillions of dollars worth of assets behind.
No, come on. Well, that makes me feel a little bit better. Well, fine. I'll hear you out there. That's absolutely right. However, one thing that I think we still have this year that you didn't have last year. You had the Arab Spring last year, yes. But we knew that the U.S. was probably going to get involved in Libya. The Saudi Day of Rage didn't materialize like you thought it was going to. This year we have Iran, a totally different situation where we actually have forecasts and scenarios laid out that are coming to us in the mail about what happens if the Straits of Hormuz are closed. This is a $80 to a $90 impact. Even a $20 impact if the U.S. just gets tough on sanctions. So we don't even have to go to war, and we have some bullish scenarios here.
Which we didn't have last year.
Okay. So the final point for everybody today, then, perhaps, is, we don't necessarily believe that we're going to have the surge like we did in 2008 on demand assumptions alone. Rosy economic forecasts, assumption that demand is not going to be impacted by high prices. But we do have this wild card. So we could get there if we had, most definitely we could potentially have a large surge if the Iran issue does not end well and we kind of dissolve there. So we'll take what we can get and we'll hope for the best.
Sounds good to me.
All right. Well, thank you everybody for joining us. And we'll talk to you again soon.